Hello, this is Raj from IndiaStockAnalysis.com. I'm an Indian chartered accountant with more than 15 years of experience in investing in the Indian stock markets. So today we are going to talk about the approach we follow to identify the stocks of truly great Indian companies and recommend them for buying at a price that has a margin of safety of 40%. It means that you will be paying only 60 pice to buy a stock worth rupee 1. Our recommended price helps you to buy shares at 40% discount. Now, how is that? We will see during this discussion. So on the payment of your subscription amount, you will be eligible to instantly download a file containing our weekly recommendations. So let's get started. So customer wealth maximization and safety of their investments is our goal. We want to help achieve financial freedom for our subscribers so that they can focus on better things in their lives. And we also want to help generate a regular stream of secondary source of income from dividends for our customers. Now, how do we plan to achieve our goals? So we plan to achieve our goals through weekly recommendations of stocks of great Indian companies at attractive discount prices. And our subscribers can download every Saturday a file containing our recommendations. And what is the approach that we follow? Let's discuss. So we have a database of around 3,500 plus Indian companies that are traded on BSE and NSE. And we have the financial data of these companies for the past 5 to 7 years. So we follow a process of in the process of identifying great Indian companies, we screen the companies that are traded on BSE and NSE. So we eliminate all those companies that do not meet our requirements. Now, what are these companies? These are the ones where the sales growth in the last 5 years is negative. So where the sales of these companies have not been growing. So we don't want to invest in such companies where the sales growth is negative. So such companies are eliminated from our analysis. Then other companies where the net profit in the last year or the latest quarter or the net profit growth in the last 5 years is negative. I mean, the loss-making companies are also eliminated from our analysis. We don't want to recommend such companies for our subscribers. And we also eliminate the companies where the operating and the net profit margins are negative, and the companies that do not generate cash. So all those companies that generate or that use up cash in their operating or investing activities and are not left with any cash are excluded from our analysis. We also exclude the companies that do not pay any dividends. Okay, so we don't want to invest in companies that do not pay any dividends at all to our investors, and where the price earnings ratio is more than 50. So what this means is all the overvalued companies and the companies that do not pay any dividends are excluded from our analysis. And similarly, those companies which have been returning negative on the equity and the companies which have excessive debt in their balance sheet are also eliminated from our analysis. We have seen a lot of companies with debt on their balance sheet which have gone down under and resulted in a lot of losses to the shareholders. So we don't want to invest in such companies. So this is the initial screening process that we follow. So once the companies are screened, around 90% of the companies listed on BSE and NSE get eliminated. So it leaves us with 400 plus companies from the various industries for our analysis. Now, what do we do with this 400 plus companies which we are left with after the initial screening process? Now we have to identify the best of the best from out of these 400 companies. So we follow a rating of these 400 companies that are left out and which are the best of the best from all the companies that are traded on the BSE and NSE. So our ratings are on a total of 100 points. So we assign to each of these companies ratings based on several parameters. Now, what are these parameters? First, sales growth in the last 5 years. So we have eliminated all the companies where the sales growth was negative. So from the remaining companies which have a sales growth positive, so we assign a rating for this particular factor. So a company with a high sales growth would get a rating, would get a higher rating as against a company with a lower sales growth. For example, a company with a sales growth of 50% would get a rating of 10, as against a company with sales growth of only 5%, which would get a rating of, say, 1. So the next factor that we rate the companies is on the basis of their profit growth in the last 5 years. A company with a net profit growth of 50% would get a rating of 10, as against a company with a net profit growth of only, say, 5%, which would get a rating of 1. Similarly, the high dividend paying companies get a better rating than low dividend paying company. A company returning high returns on equity gets a better rating than a company with lower return. Similarly, debt to equity is also one of the factors which we rate the companies on. A company with a lower debt gets a better rating than the company with high debt. We also use something called as a magic formula. This is popularized by Joel Greenblatt in his book, the little book that still beats the market. The magic formula is a combination of earnings yield and return on invested capital. So the higher the magic formula, the higher the rating the company gets. So price to earnings and price to book value. So companies with lower PE and the lower price to book value get a better rating than the ones with a higher PE and higher book value. Now, price to earnings and price to book value are the factors for identifying the undervalued companies. So at the end of this rating exercise, we would have assigned ratings to all the 400 plus shortlisted companies. So we add up all these individual ratings and come up with an overall rating for each stock. Then from these rated companies, we choose the top 20 for further analysis for recommendation to our subscribers. So our recommendations are weekly, and our subscribers will get to download a file from our website upon subscription on every Saturday of the week. So that was about identifying the best of the best companies traded on BSE and NSE. That was the first part. The second part is to suggest the maximum price that can be paid for these identified companies. So in the first part, we identified top 20 great Indian companies based on the initial screenings and ratings. Now in the second part, we suggest the right price to pay for these stocks to be able to earn a minimum return of 25% per annum. So our goal is to help our subscribers earn a minimum return of 25% per annum. And identifying this right price to pay is our unique selling point. So we use the principles discussed in great books written on value investing by value investing gurus such as Ben Graham, Dr. Phil Town, Joel Greenblatt, and Monish Pabrai to identify the right price to pay So we use a margin of safety of 40% in our recommendations. And our target prices are set to return at least a minimum compounded return of 25%. So it means that you will be paying only 60 pies to buy a stock worth ₹1. So the margin of safety means that the price that you pay now for the stock would have a discount of 40% on its future value. So this is the maximum price you should be willing to pay for these stocks. For example, if based on our analysis for a company, based on its growth rates and other factors that we consider, we think that the company is going to be quoting at 1,000 rupees at the end of 3 years from now. We would see what price would amount to 1,000 at the rate of 25% if paid today. So that would be around 600. So 600, if we pay 600 for a stock today, which we expect will quote at 1,000 at the end of 3 years, then we would be earning a return of 25% on it. But our recommendation price of 600 would be lesser than 600. So we apply a margin of 40% on it. So we take away 240 and we ask the customers to pay only 360. So that is for so you don't have to pay more for a stock. So you'll be paying much lesser for the stock that is going to be valued at 1,000 in 3 years from now based on the growth rates. So if the current price at which the stock is quoting is less than the recommended price, then you buy the stock. Otherwise, you add it to the watch list for buying at a later date when the price reaches that level. So we recommend the target prices and the maximum price to pay for 1 year and 3 years. So these are extremely good companies, those companies that have survived our research, and ratings are extremely good companies which are currently available at 40% discount and which have the potential to become multi-baggers in future. So dividend from these companies would be an additional source of income on your investment. So this is how our final product will look like. So on the payment of your subscription amount, you will be eligible to download an Excel file. So you can see how the Excel file that how this Excel file looks like. So this is a sample final product on. So these are some of the best and the great Indian companies that are growing fast in terms of sales and net profit. They are dividend paying, they are cash rich with low to no debt. And these return, they also return high rates of return on equity and invested capital and are available at attractive discount prices. So for example, if you take the first line, Bamal Lorry Investments, the BSE code is 532485. It's in the finance industry. So the current price for this is 471.3 as at the time of making this video. So it has an overall rating of 92. So we talked about rating, how we aggregate the ratings on several parameters and assign one single consolidated rating to the companies. Now here our recommendation for this particular stock for 1 year. So we have given our recommendations for 1 year, which is highlighted in the blue here, and we also give a recommendation for 3 years. So the recommendation for 1 year is add to watch list. I mean, you're not supposed to buy this company now. You can add it to the watch list. The target price for 1 year is 486.67, and the maximum price to pay for 25% return per annum is 283. So you should not pay anything more than 283 for this particular stock if you have to earn a return of 25% per annum for 1 year. So current price is 471. So the maximum price that you should pay is only 283. So therefore you add it to the watch list. Then coming to the 3 years recommendation, the 3 years recommendation is also adding it to the watch list. It's not buying now because the target price for 3 years is 631.45. And the maximum price to pay for compounded 25% return per annum is only 255.8. So you have to add this company to the watch list and buy it only when the price reaches either 255 or 280 levels. But there are some companies which are available for buying right now. For example, IOL Chemicals. Its current price is 552. And the target price for 1 year is 747, and the maximum price to pay is 436. But from a 1 year perspective, you need to add it to the watch list and buy it only when the price reaches 436. So we are very, very conservative about our maximum price because that is the only way to benefit, or the only way to profit from the stock market is to pay as low a price as possible. You should never be paying anything more than what the company is worth. So for 3 years, for IOL Chemicals, the target price is 1,403.05. And the maximum price to pay is 568. So since the maximum price to pay 568 is compares favorably with the current price, and the current price is lower than that price, so you can go ahead and then buy the script and wait for 3 years when it touches, and sell it within 3 years if it touches 1,403. Hope you like this video. You can check out our products at https://indiastockanalysis.com/shop. You can also join our Facebook group. Thank you for watching.